Nvidia beat sales expectations during its fiscal first quarter, but forecast second quarter revenue below market estimates on Wednesday, May 28th, expecting an $8 billion hit to sales from tighter U.S. curbs on exports of its AI chips to key semiconductor market China. Shares of the world's most valuable semiconductor firm are relatively flat so far this year, compared with 2024, when the shares nearly tripled in value. Nvidia now faces trade restrictions on what it can sell, and the AI data center market is also maturing. Washington's years-long efforts to thwart Beijing's access to top-of-the-line U.S. technology have resulted in stricter restrictions on the export of Nvidia's AI chips, stifling the company's access to one of the largest markets for semiconductors. New U.S. restrictions on the sale of Nvidia's H20 chips to China, the only AI processors it could legally export to the country, prompted Nvidia to disclose in April that it expected a $5.5 billion charge, while CEO Jensen Huang had in May pegged the revenue impact related to the restrictions at about $15 billion. On Wednesday, Nvidia said the actual first quarter charge due to the H20 restrictions was $1 billion less than expected because it was able to reuse some materials. It said it lost $2.5 billion in H20 sales in the first quarter and expected to miss $8 billion in the second quarter. Though major cloud companies such as Microsoft and Alphabet have stood their ground on the billions they have earmarked this year for spending on expanding infrastructure for AI data centers, worries about such spending persist amid rapidly changing global trade policies. On an adjusted basis, Nvidia earned 81 cents per share in the first quarter. Analyst estimates varied widely as Wall Street tried to assess the impact of restrictions on some of Nvidia's chip sales to China. Excluding the charges, first quarter adjusted earnings per share would have been 96 cents. According to data compiled by LSEG, the estimate for the company's adjusted quarterly earnings was 93 cents per share, with 17 analysts providing estimates after April 15th, when Nvidia said H20 shipments would require additional licenses. The artificial intelligence market bellwether expects revenue of $45 billion, plus or minus 2%, in the second quarter, compared with analysts' average estimate of $45.90 billion, according to data compiled by LSEG. The forecast includes a loss in H20 revenue of about $8 billion due to the recent export limitations.
Investors can breathe a sigh of relief that the China revenue impact is now known a bit better, and it's not as severe. Meanwhile, the Blackwell products and the transition to the newer Blackwell architecture is in full swing, better than anticipated, and there's still plenty of demand in developed markets and elsewhere. So Nvidia is still in a tremendously strong position in AI in the markets it's allowed to serve. And with China, we'll see. Again, we're not necessarily betting on a China comeback, but that's pure upside if there is. The restrictions right now are really just enabling Nvidia's competitors, and that might not be the best thing for the United States of America. We'll see how that plays out. But as of now, they were pretty clear that the restrictions are quite strict. It won't allow Nvidia to sell anything decent into China, which is what we expected. They say they're working on trying to get around it even further, but the restrictions are very strict. And so, we're not holding our breath and waiting for Nvidia to start selling more into China. We think they are effectively blocked from selling anything decent in terms of data center products unless these restrictions get lifted. If you're looking for upside in Nvidia, it is more deals like this, more government sovereign deals for countries that can clearly afford it, right? When you think about companies, a lot of this AI growth, whether it's the Microsofts or Metas of the world, they're doing it with free cash flow. So that's always reassuring to investors that they have the cash to fund this AI build out. So now when you get to selling into countries like this, of course, they can raise the debt to fund these build outs as well. So that's highly encouraging for the progress of these data centers. The UAE deal is absolutely massive. The Saudi Arabia one is important. And on the call, we heard Jensen say that basically every country is coming to him wanting to build out AI. So we think that's going to continue. That will probably drive upside, and that's the bull case on this stock. If you're bullish on AI at this point, you need more and more deals like Saudi and UAE to get going, and it seems quite possible that could occur.